All right, so this is our Financial 15 segment, and we're continuing the portion that is essential financial lessons for young adults. So if this is your first time joining us on YouTube, hit that subscribe, like, and notification button. If you want to see the weekly webinar that this is the tail end of, you can go back and look at our weekly webinars on our YouTube channel or on our website. Our website is attleborowealth.com. I'll put that up there. That's attleborowealth.com. And if you have questions for us, you can email us at questions@attleborowealth.com. So back to our presentation here. Where did this presentation come from? So if you've been following along for the past several weeks, you know that I was invited to speak to my two kids' college and the honors program at the college, and they said, would you talk about financial literacy, put together a presentation. And I really enjoyed the work in putting it together, and I greatly enjoyed the feedback. I was just told that yesterday or the day before from my kids that they've gotten a lot of good feedback from kids about it, and even staff, and that's great. And I again, this is about education. If I can help in any way, that would be amazing. So we talked already about debt, and we talked about banking and fees and debt costs, and then our last segment we talked about stocks, so about growing your money in stocks. Now we're going to talk about growing your money in bonds, and isn't this convenient? Because we just read an analyst report focusing on bonds. So grow your money investments, and this is bonds, and this is what's referred to as fixed income. So people in my industry like to get really fancy. We talk about fixed income. We talk about equities instead of saying bonds and stocks. So bonds is fixed income. Equities are stocks. A bond, it is a definition of a bond. If you're just listening, a bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond can be thought of as an IOU between the lender and the borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. So if you buy a U.S. Treasury bond that's issued by the federal government, you've lent money to the federal government. They have to pay you interest. And that interest is what you earn along the way. We're going to talk more about that. But it's just like going to a bank and borrowing money. They're lending you money. You pay them interest. You can do the same. You can lend somebody money in a bond, and they pay you interest back, and hopefully eventually give you your principal back. And this definition comes from Investopedia. You can see where it comes from right at the bottom of the screen. So if you want to go there, Investopedia is a great resource for real basic information and even some detailed information. I use Investopedia when I'm putting together my webinars all the time. So it's a great resource. And of course, this is an example only. It's not a recommendation to buy, hold, or sell a security. You're going to see this on every slide, and I can't say it enough. Investment decisions are very individualized. You should not get your investment advice from anybody on YouTube. Don't take even the education I give you as advice on YouTube. Take it as education. Let it inspire you. Let it allow you to grow. Let it allow you to make good decisions. But don't take it as investment advice. So continuing with bonds, there are two ways to grow your money with bonds. That's interest. You are the bank. You're lending your money to someone. They're paying you interest. There's also potentially a price increase. You buy a bond at $1,000 issue for a few different reasons. The bond can go up. The value of the bond can go up or it can go down. And if it goes up, you can sell that bond and then realize the price increase. So let's talk about interest. The borrower, that's the issuer, again, the federal government, or, here we're in Newtown Township here, where my office is located. Newtown Township issues bonds. We're in the Council Rock School District here where I live. The Council Rock School District issues bonds. Surely your municipality where you live or your school district where you live, and certainly the state where you live, and our federal government issues a whole lot of bonds. That's why our debt continues to increase. And as of today, April 30th, 2024, it's about $34 trillion. I'll leave that alone for now. So grow your money investments, bonds. We're talking about interest. The borrower, that's the issuer, issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loaned funds, that's referred to as bond principal, must be paid back at the maturity date. So if you're listening during our weekly webinar just now, I was talking about maturities, 10-year maturities, 20, 30-year maturities. So there's a lot of different maturity dates that can be purchased with bonds. Typically, the shorter the maturity, the less interest you get. The longer the maturity, the more interest you get. But not today. Today, you get more interest in shorter maturities and less in longer maturities. And that's an inversion. That's upside down. Things are upside down right now. The interest payment, the coupon, that's what it's called. That interest payment is called a coupon, is part of the return that bondholders earn for loaning their funds to the issuer. That interest rate that determines the payment is called the coupon rate. So grow your money, bonds. Who issues the bonds? Governments and agencies, U.S., state, and local, schools, and corporations. So our local community college here issues bonds. That's why I use this as an example. So I forget what the number was. It was something like $15 million that they issued for renovations. Current interest rates, the 10-year U.S. Treasury. So this was as of about 45 days ago. The 10-year U.S. Treasury was at 4.39%. A 10-year municipal bond, Pennsylvania municipal bond, was at 3.39%. And the 10-year corporate bond was at 5.12%. So why do we see these variances? Why do we see these differences between the 10-year U.S. Treasury, 10-year Pennsylvania municipal bond, and a 10-year corporate bond? So the U.S. Treasury is considered the safest investment in the world. So that means that if you put your money into, you're a bond holder, so you give the federal government $1,000, let's say. They're promising to pay you back that $1,000 in 10 years, but they're paying you 4.39% interest along the way. So you'll receive your interest credits periodically along the way, and at the end of the 10 years, they'll pay you back what they borrowed from you. The reason that you see municipal bond rates cheaper is that they're typically tax-free. So you won't pay state, local, and tax on those municipal bonds. So they're typically a notch below what you see in taxable. So the U.S. Treasuries are taxable bonds. Corporate bonds, that's and again for the same 10-year duration. For corporate bonds, you see 10-year corporate bonds are at 5.12%. The reason that we'll see on average a corporate bond being higher percentage than a U.S. Treasury or a Pennsylvania municipal bond or any state municipal bond is because there's additional risk involved. We know that U.S. Treasuries, Pennsylvania, the state of Pennsylvania, the state of New Jersey, state of California, whomever, local municipalities, local school districts are taxing authorities. So there's less risk that they're going to default. Corporations, it's based on earnings. There's no taxing authority, so you get paid more interest for that additional risk that you're taking, even though the duration is the same. That 10 years that we're seeing here, I don't know if I can draw on this. I can't draw on that. Oops, is the same. I hope that makes sense. So they're different examples of different risks. Very, very safe investment in the U.S. Treasury, but 100% taxable. 10-year Pennsylvania, for example, Pennsylvania could be any state municipal bond, but that Pennsylvania is 3.39, still considered a safe investment. You got to, there's a lot more that goes into it with states, but is considered tax-free. Now, it's not completely tax-free. There are things that tax-free interest or interest from municipal bonds create taxation, Social Security, things like that, but fundamentally, it's considered tax-free. It's not completely tax-free though, but the 10-year corporate bonds, again, additional risk because you're basing it on the paying abilities of a corporation, not of a municipality, a government agency, a taxing authority. So that's how you increase you grow your money by interest. Now, what about price increases? If you buy a 10-year bond issued for $1,000 at 4% today, so if you're getting 4% for a 10-year bond that's issued at $1,000 today, and then next month, that same issue, say it's U.S. Treasury, say interest rates come down, that same 10-year bond, and the U.S. government issues a 10-year Treasury again next month, that same bond is issued same $1,000, but you're only getting 3.5%. That makes your bond more valuable. So now people will say, well, wait a minute. I'm pretty close to that same 10 years. I'm getting 4%. I can sell my bond. So you can actually sell your bond out on the markets and you'll make $50 in this example. So not only do you have the opportunity to earn interest, but when the price adjusts and your bond is worth more than what you paid for it, you can sell it and you can make a profit on that price increase. Now you can also have a loss, of course. So if next month that price adjusts to 4.5%, when you look at your bonds on your statement, they're going to be worth less. And here is the example of that. So 10-year bond issued for $1,000 today at 4% rate. If it's issued for 4.5% next month and you had to sell your bond, you'd sell your bond for $950, so you lose $50 on that one. Again, this is an example only, not a recommendation to buy, hold, or sell a security. Now let's talk about mutual funds. So that's bonds. A lot of people invest in mutual funds. So what's a mutual fund? A mutual fund lets you pool your money with other investors to mutually buy stocks, bonds, and other investments. They're run by professional money managers who decide which securities to buy, stocks, bonds, etc., and when to sell them. You get exposure to all the investments in the fund and any income they generate. They offer a wide variety of investment strategies and styles, and that definition comes from Charles Schwab, and you can see where that comes from. Something that's become very, very popular lately is, in the past 15 years or so, are exchange-traded funds. So exchange-traded funds, or ETFs, are exactly as the name implies, funds that trade on exchanges, generally tracking a specific index. When you invest in an ETF, you get a bundle of assets you can buy and sell during market hours, potentially lowering your risk and exposure while helping to diversify your portfolio. Let me talk a little bit about ETFs and mutual funds. So there's been a lot of progression towards ETFs, and that's because ETFs tend to have lower fees. Lower fees are very, very important. You should be paying attention to those things when you're choosing your investments, just like when you're choosing your bank accounts and the fees associated with your bank accounts and using any credit you have and what costs are involved in those credits. Because if you just invest in mutual funds and kind of throw a dart at the board or buy the same funds, somebody who bought, they may be anywhere from, it really ranges from very low fees to very high fees. So very high fees can pull down the performance of the portfolio. So a key thing to pay attention to, a critical item when you're starting out and investing and learning about these things, is that you only pay for mutual funds that outperform. And there's a lot of good resources for that on the internet. One of them is Morningstar, and you can do some limited research on Morningstar with mutual funds. But you want to look at the cost of the fund. And again, a fund could charge you 2%, but if they're outperforming their peers and what we call a benchmark or an index that it's tied to by, they're charging 2% and they're outperforming regularly by 4%, that may not be a bad fund. The problem is there are many, many mutual funds. I'm just going to go back to mutual funds since we're talking about this. That there are many, many mutual funds, just about 92% of them, who underperform or are mediocre. And you don't want to pay for underperformance. You don't want to pay for mediocre. You've got to spend some time researching these things and looking at them and learning about it, or find a person who can help you with it. That's why many people have migrated to ETFs. ETFs can be cheap and can be efficient, but they should be both cheap and efficient. If they're cheap and they're inefficient, it really doesn't work well. If they're efficient and too expensive, it probably doesn't work well either. It oftentimes makes sense to have a blend of both mutual funds and ETFs. It's just finding the right ones. So there's a lot of detail there about finding the right ones. And frankly, that's where we spend so much time when we're developing our investment portfolios, is finding the right ones. So here are some key items. Start early. Key item, start early. I've never had anybody sit down across from the webcam or across from the table who said, gee, I wish I would have waited 5 more years. Start early. Pay yourself first. You should start with 10% of your income. That should be the number one goal. Start with that. If you can get to the 10% of your income, and then you can move it up from there, I suggest that you look up the video or read the book, The Richest Man in Babylon. It's about a 7-minute video on YouTube, but it's a really small little book if you like to read. but it has a really nice foundation of just saving and investing. So again, that's the richest man in Babylon. So pay yourself first, 10% of your income. You're going to pay your bills. You're going to find a way to pay your bills. You're going to find a way to pay your home. Hopefully you don't have too much debt, but you're going to find a way to do the things that you want to do and that you need to do that come out of your income. But first, you want to focus on paying yourself first. That will add up quickly over time. And by the time, if you're listening to this and you're 20 years old, 22 years old, by the time you're 40, you're going to see, maybe even before that, you're going to see the effect of just that. If that's the only thing you get out of this, 10%, pay yourself first, 10% of your income, you're going to see the effect of that. And when you see that, reach out to me. Reach out to me and let me know that helped you. I'd love to hear that. Put as much as you can in your retirement account. If you've got a retirement account at work, this money comes out before you see it. It should probably go into a Roth option if you have that available, but that's an individual choice, and you want to look at all the pros and cons about that. But put as much as you can in your Roth account, or your retirement account. Put as much as you can in your retirement account. Maximize it if you can. There is a maximum contribution level that you can do each year. Find out what that is and strive for that to be your goal and work towards that. Make it systematic and on autopilot. Whether you're saving for your retirement plan, that'll be if you're working for a company, that'll be a systematic. They'll take it automatically out of your paycheck. That's why people build up millions of dollars in their 401ks and other retirement plans, because it's done without them thinking about it. Systematic and autopilot. But even on your own, you can set up a distribution from your bank account, from wherever your cash funds are going, to whatever investment vehicle you're using, whether it's Schwab, Vanguard, Robinhood, whatever your vehicle is. If you're sweeping over, even if it's, the beauty of today is you have things like Robinhood where you can buy, and that's not a recommendation to use them. I don't know much about them other than the fact that you can buy small portions of securities there, invest small amounts of dollars. When I first started investing, I remember calling my mother-in-law worked for an investment firm. She still works with us today, but she worked with an investment firm, and this guy was doing me a favor by buying me mutual funds and sometimes individual stocks, and always fault me about buying individual stocks. But you don't have to do that anymore. You can go online. You can set these things up on your own. You can watch them anytime, and you can find really the same research that any professional can find. It's just how to go through it. But make sure it's systematic. Make sure it's on autopilot. And consider after-tax contributions, whether it's your retirement plan, you set up an IRA. Have something where you're paying the tax now and you don't have to worry about it later, especially when you're starting early and maybe you're in a lower tax bracket and your income's low, but probably through the rest of your life. But that's a consideration you have to make with a qualified tax planner, qualified financial advisor. All right, and that is the end of that presentation. So that is the end of that series also, folks. So that is Essential Lessons for Young Adults. I'd love to hear your feedback on this. I know a lot of you listening, at least live here, are probably a little older than young adults, but I'd love to hear your feedback on that. And I'm going to potentially continue to grow this presentation and maybe do a separate course online for it. But I'd love to hear your input, because you're all very wise individuals who have been at this a long time. I'd love to hear what you have to say. If you are a young adult that is just listening to this for the first time, I'd love to hear your feedback as well. Folks, that's it for today. I hope you have a great week. I hope you got something out of our time today, and I'm looking forward to seeing you next week. Take care. Bye-bye.